share. What are we supposed to know about earnings per share? Very easy concept. Earnings per share, ladies and gentlemen, this is a performance appraisal metrics. Metric, I mean, to get earnings per share, which is normally acronymed like this, EPS, earnings per share. Basically, we shall take what we call the total earnings. Total earnings, all over number of ordinary shares. Total earnings, all over number of ordinary shares. Total earnings, all over number of ordinary shares. So please ensure you're writing these things as we progress. Anytime they want us to give them EPS, we shall always work with the total earnings all over number of ordinary shares. But which earnings are we looking at? These are basically earnings which are attributable to ordinary shareholders. So please qualify these by saying that these are total earnings attributable to ordinary shares, attributable to ordinary shares, attributable to ordinary shareholders, please write like that. Attributable to ordinary shareholders divided by the nose, Nose, this one is number of ordinary shares, remember. Nose is number of ordinary shares. Number of ordinary shares. Very important, ladies and gentlemen. Exercise number one. They have given us, in this case here, profit attributable to ordinary shareholders. Profit attributable to ordinary shareholders. Profit attributable to ordinary shareholders, they have given us 10 million. And then we are given here a number of ordinary shares, they are 2 million. And then somebody in this case here wants you to get EPS. Somebody wants you to get EPS. So remember, this is profit attributable to ordinary shareholders. Profit attributable to ordinary shareholders is 10 million. And then number of shares are ordinary shares. Number of ordinary shares are 2 million. Then they want you guys to do something very easy. They want you guys to get what we call earnings per share. Earnings per share. They want you to give them earnings per share. So how do we get earnings per share? The formula is already here. It is profit attributable to ordinary shareholders, which apparently we happen to be having, which is 10 million divided by 2 million. So you kindly, of course, you can see the answer here. The answer here is 10 over 2, which gives me how much here per share? Every share. Each share that we have is earning Kenya shillings what here? 5. Kenya shillings 5 is earning Kenya shillings 5. Ladies and gentlemen, listen and listen to me very well. Of course, this is a useless example. This is a very simple example. At this advanced level, you can never get anybody who gives you this kind of a question. So please mention there, example 2. So example 2, ladies and gentlemen, this guy has done something very wonderful here. Example number 2, this is what we have. Example number 2, we have in this case here, profit after tax. Profit after tax, ladies and gentlemen, this has been given as 10 million. And then we have what we are calling preference dividends of 2 million. And then we have number of ordinary shares of 2.5 million like that. And then they want you to do something very simple. They want you to calculate EPS. I'm so sure now this one, very many students will not be able to get this correctly. But you guys, I know you are above there. You're bright. You guys are bright. So they've given us, this is preference dividends, profit after tax, right? And then we have here a number of ordinary. Whenever you see nodes, Whenever you see NOS, be it in advanced FM, be it in advanced FR, NOS stands for what here? Number of ordinary shares. Number of ordinary shares. Thank you very much. I can see what Eric Odinga has given me. Eric Odinga has known, ladies and gentlemen, that for us to be able to get profit which is attributable to ordinary shareholders, first of all, you must give a preference to preference shareholders. Pay them their dividends first. So they have gone ahead to give me now an improvised formula. Eric has told me that in this case, ladies and gentlemen, to get EPS, take profit after tax minus preference dividend. Minus preference dividend, and then you will come and divide this by the number of ordinary shares that you have. So you take profit after tax, you give first of all, in this case here, you appropriate preference dividends from there first, and then whatever is left is now the profit, which is attributable to ordinary shareholders. Right? Great. So then the profit after tax is 10 million minus preference dividends of 2 million, all of a number of ordinary shares of 2.5 million, which at the end of the day will end up giving me what figure? Which at the end of the day will end up giving me what figure as EPS, earnings per share. Earnings per share. Somebody already had gotten this earnings per share. Somebody already had gotten this earnings per share as 3.2. You guys are very bright. Can I go to the third exercise? Can I go to the third exercise? Can I go to the third exercise? Yes. Now, this third exercise is the most interesting, and I'm so sure you can even bet. If you guys like betting, you can bet. You can bet 1,000 bob. If you get this correct, I give you 1,000. If you don't get it correctly, you give me 1,000. Is there anybody who is ready for a bet? Is there anybody who is ready to bet with me here? Is there anybody who is ready to bet with me? Is there anybody who is ready to bet with me tonight? Anybody who is ready to bet with me tonight? You can't get this one. This one we can bet. Exercise number 3. So for this exercise number 3, they have given us profit after tax, right? 10 million. Then they have given us preference dividends. Preference dividends of redeemable shares. Redeemable shares, and then we have here preference dividends of irredeemable shares. So this is 1 million, this is 1.5 million, like that, and then we have the number of ordinary shares, which are 2.5 million, like that, and then they want us to give them the EPS. How I wish that I bet with you guys. How I wish I had a bet with you guys. Madam Queen, we have also just begun. And this is exactly what we are doing. This exercise, just join us from here. Join us from here. Like a buffalo soldier who fights on arrival. A buffalo soldier, you know, buffalo soldier, the American buffalo soldiers. If you're not careful, these guys will give you very bad shots. They'll shoot you, right? So you simply jump down from the vehicle here right away when you are shooting. Yes. So we have profit after tax, 10 million. We have preference dividends of redeemable shares, 1 million. We have preference dividends of irredeemable shares, 1.5 million. And then we have a number of ordinary shares of 2.5 million. So they simply wanted to get EPS. So which dividend am I going to subtract here? Which dividend am I going to subtract here? Am I going to subtract both of them, or preference dividend of irredeemable shares? Which one should I subtract? Now they are not talking. They're not talking. So, ladies and gentlemen, listen and listen to me very well. Remember, redeemable preference shares, these ones are normally treated as what here? as a loan. The money will be returned back. And whatever in this case here you pay out as dividends out of this nowadays is being accounted as finance cost, as interest. Ladies and gentlemen, it's only irredeemable shares that are normally classified as a form of equity. Remember, equity components are non-refundable, like ordinary shares. There is no way to come and tell me if I issued at the primary market, I gave you like 10 shares of RCM college, then later on, if you see things are not working, you can't sell those shares back to the college. You can never redeem your money. If you're so tired, go to the secondary market and sell those shares to another person there. So we only work with irredeemable instruments whenever it comes to calculations of what here? EPS, irredeemable, 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 irredeemable. So abracadabra, ladies and gentlemen, this is what we have. So we are calculating the profit attributable to ordinary shareholders. Attributable to ordinary shareholders, profit, or rather EPS, we are saying EPS here will be equal to profit after tax minus preference dividend of irredeemable shares. Preference dividend of irredeemable shares. Preference dividends of irredeemable shares. All over, Jackie. Now I hope this makes it clearer. All over number of what here are ordinary shares. All over number of ordinary shares. So Jackie, you can see I've already factored in preference dividends of irredeemable shares. So I hope that makes this clearer. Right. So the profit after tax, ladies and gentlemen, is 10 million minus preference dividend of these irredeemable shares, which is 1.5 million. All over, ladies and gentlemen, all over, number of ordinary shares, which are how many here? 2.5 million. Great. Great. So is there somebody who got this really correctly? Is there somebody who got this right? Eric alone, right? Lenovo person, Ankara Align, AA. Great. Those are three. So I would have given out 3,000. But you see, in the process, I would have gotten 40 what? I would have gotten 46. I would be a rich man. I would be a rich man tonight. I wish we had a bet with you guys. I would be a very rich man tonight. Thank you so much. So now I want to give you the fourth example, which is a very important example. The fourth example, which is a very important example. So can I rub this? 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 Abracadabra, yes. Saumu Sumba, SS. Great. Great. Ladies and gentlemen, here we are. So this example is a nice one now. This example, yeah, they have given us, in this case here, profit after tax as 10 million. And then we have here 1st of January 2020, we issued 1 million shares. And then we have here 1st of April 2020, we issued out again some new shares, 800,000. And then, ladies and gentlemen, we have here 1st of September 2020, we issued 500,000 shares. 500,000 shares. So this is supposed to be exercise number 4. This is supposed to be exercise number 4. So these guys here want you to do something very simple. They want you to calculate the earnings per share. They want you to calculate the earnings per share. So could you kindly help me out here? Calculate the earnings per share for us. You can see now here, issued 1 million shares. Remember, all these are ordinary shares. All these are ordinary shares. that were issued in different dates. That were issued in different dates. That were issued in different dates. The financial year, it is 2020. Remember, we are working from beginning of 2020 up to the end of 2020. End of 2020. 31st of December 2020. So EPS 31st December 2020 like that. EPS 31st December 2020. Thanks for asking that question. That shows me that, Eric, you're a good financial reporter. Good financial reporters are very sensitive with dates. When are we supposed to be reporting? When are we supposed to be reporting? So abracadabra, abracadabra, abracadabra. What do we have there? Abracadabra. What do we have there? So I know what is at the back of my students' minds. My students' minds, of course, I have got great students. Great students, in this case here, we're not thinking like, how do we account for hyenas as biological assets, right? Great students who have great memories. So these great students must be telling me that, Mwalimu, in this particular situation, for us to get EPS, there must be a one-nose to be used somewhere. There must be a one-nose. There must be a one-nose. There must be a one-nose. Is there somebody here who has never heard of this word since they were born? Is there anybody who has never heard of this word before, since they were born? This is the very first time they're hearing this word, one-nose. Please don't fear telling us the truth, because we shall know. What do you mean? You've never heard of one-nose. We shall overcome, right? So then right there in full, that one-nose stands for weighted average number of ordinary shares. Weighted average number of ordinary shares. Patrick Talia, PT, has already given us the full meaning of one-nose. Of one-nose. Weighted average number of ordinary shares. So the first thing that we need to do is to calculate the weighted average number of ordinary shares. Is to calculate the weighted average number of ordinary shares. So first of all, before I endeavor onto this journey of calculating these one-nose, I would want to know whether there is any student who has been able to finish getting the EPS. Is there anybody who has been able to finish? So one-nose I'm being given here by Bwana Guga is giving me one-nose of 176.66, and then EPS is 5.66. The final answer, EPS is 5.66. Thank you, and thank you so much. You guys are very bright. You can see, you guys, I said this even before we began, that these guys are bright students. So ladies and gentlemen, then, in this case here, what am I supposed to do here now right away? So of course, when I'm calculating this one-nose, the money will not be used anywhere. One-nose, basically, I'm weighting my shares, I'm giving my shares weights, which are time proportions based, time proportion based. So in this case here, then what I need to do is something very simple. I will make a table. And in this table of mine, I will start by writing the date here. Then I have description here. And then we have, ladies and gentlemen, another column here for cumulative shares, cumulative shares, cumulative shares, cumulative shares. And then we have another thing here for time proportion, like that, like that, like that. This is quite a simple example. This is a simple example. Now listen and listen to me. The first date that we have here is 1st of January 2020, when we issued how many shares? 1 million shares. We issued 1 million shares. So cumulatively, nothing much really to talk about here. It's 1 million there. Now from there, you go to the second one. The second one, we had this number of shares being issued on this date. So you take this and accumulate here, we are getting 1.8 million. All right. So the last one, please accumulate to this, which gives us 2.3 million. So first of all, are we together up to there? First of all, are we together up to there? First of all, have you been able to see what you have done for us to be able to get, in this case here, this cumulative, I've only accumulated these shares downwards. Right? Can somebody in this case here help me answer Emmanuel? Emmanuel is quite a big name, right? We are simply doing some example here, Emmanuel from Walimu's head, right? And then now from there, ladies and gentlemen, I would want us now to count the number of months, of which in this case here, there are 2 ways. And the way that I would recommend to you, and I'll tell you why, the way that I would recommend to you over counting this number of months, I would want us to be counting the number of months between the 2 transactional dates. 2 transactional dates. I mean, from 1st of January to 1st of April. How many months do we have here? Please start counting them. Please count them from 1st of January to 1st of when? April. How many months do we have? So you count. So we have January, we have February, we have March. Don't count April, because April, we were just beginning there. So here we have got how many months? Here we have got 3 months. How about from 1st of April to 1st of November, or rather September, 1st of September? Please count for me. How many months do we have there? Jackie is telling me 5 months. 5 months. You count from 1st of April. So the whole of April, May, June, July, September, no. Please count very well. Count very well. So we have April, right? So we have April, May, June, July, right? July, August. Don't count September. Don't count September. It's 5. You guys are right. Now, because we only had the 3 transactions in the year, the last transaction, you don't have to count the number of months, because normally we account for a whole year. The last transaction, always take it to be what year? Balancing figure. So balancing figure, to enable this give us 12. This will be what year? Somewhere. The balancing figure will be how many months? The balancing figure here, to make it 12. We want to account for a whole year. So it's 4, isn't it? It's 4. It's 4. It's 4. Oh, alternatively, you can also count from, in this case, ladies and gentlemen, September, October, November, December, up to the end, December. There are 4 months. You can count. There are 4 months. You can count there. You can count from right away September, October, November, December. There are 4 months like that. So of course here we have these are supposed to be time proportions. So 3/12, 5/12, 4/12. And because we don't have any bonus fractions, now come and create a column for one nose. So one nose, you simply take the cumulative shares times the time proportions, like 1 million times this. Please give me a figure to write here. 1 million times 3/12. This gives me how much? This gives me how much? 1 million times 3/12. 1 million times 3/12. 250,000, Rosie. 250,000. How about 1.8 million times 5/12? 1.8 million times 5/12 inakuja ngapi oye? Wanasema ni 750,000 eh? 750,000, 750,000. And then the last one, ladies and gentlemen, is this 4/12 times 2.3 million. 4/12 times 2.3 million, oh yeah. Oh yeah, nipatie madecimals kidogo. 2.3 million times 4 over 12. 2.3 million times 4 over 12. 766, 666.67. So please come and add for me to be able to give me what we call the total 10C. Total 10C. Total 10C. Total 10C. So the total 10C will end up giving us how much? Total 10C. Total 10C will end up giving us how much? 176,600. So we have here 176, right? 176, 666, 666.67 like that. So 1 million. Don't kitu ingine mzuri. Kitu ingine mzuri. Hebu soma mzuri. Eka makoma mahali. Ukitaka kusema eka koma mahali. Unajua koma ziko wapi? You must use separators. You must use separators when you add. You must use separators. Why would you want to disturb mwalimu now? Why do you want to disturb mwalimu? 1, so there is a 6 I've left in between. There is a 6 I've left in between. Oh, yeah. Like that. So this is the 10C. And once I have the 10s, then getting EPS will not be a big issue. Getting EPS will not be a big issue. Getting EPS will not be a big issue because to get EPS, we'll take, in this case here, our profit after tax, they are not preference dividends here. Profit after tax, all over now, what we call the 10C like that. So who can remind us what was the profit after taxation? What was the profit after taxation? Abracadabra. What was the profit after taxation? Thank you very much. So it is 10 million divided by 1,766,666.67 like that. To divide like that. So if we do it that way, we shall be able to get earnings per share. Earnings per share, which will be 5.67 like that. 5.67 like that. And I know there are those students who will tell you that, you know what, we stayed with these shares for 12 months. The others, no, I don't use that approach at all. I don't like that approach at all, and I'll be able to prove to you that my approach is superior. My approach is superior. So first of all of us, are we now together here as pertains calculations of 1/0 especially? Are we together as pertains calculations of 1/0? Are we together? Yes. Thank you very much. Great. Great. Thank you very much. Now, ladies and gentlemen from there, I would want us to remind ourselves. Let's remind ourselves. What have we said here? We've got what we call, what we've calculated so far is called the basic earnings per share. Profit attributable to ordinary shareholders of the parent divided by weighted average number of shares, what we call 1/0. Or simply put, it is part minus preference dividends all over 1/0. But of course, at your level, you will not be required just to do this. You must go a step further and calculate diluted EPS for us. You must go a step further and calculate for us what we call diluted EPS. This is saying that the basic EPS might get worse due to things that are already in issue. That we have, ladies and gentlemen, outside here, we have been able to give what we call a convertible loan. So there are people like now what Kenya Airways did. They gave, or not Kenya Airways, but Equity Bank. In this case here, gave Kenya Airways a convertible loan. So Kenya Airways basically gave what we call a convertible bond. They gave equity. We got a loan, we gave a bond, that instrument, convertible bond. So what does it mean? One of the fine days, ladies and gentlemen, you will get Equity Bank coming and telling you, hey, we don't want our loan back. Stay with it. Would want, in this case here, our loan to be changed to ordinary shares. So if we change these to ordinary shares, it means automatically that now Kenya Airways number of ordinary shares are going to really become too many. And then, of course, when they become too many, profit being the same and the base has grown, the denominator has grown, then automatically the EPS will be diluted. EPS will go down. So dilutive, those instruments in this case here that have got impacts of what you're diluting EPS, reducing the EPS, very important. The same case with stock options. Stock options, these are given to senior managers. You are telling these managers that, hey, when you are retiring, assuming that the performance of the company will be in the heavens up there, very high, we are giving you a right, but not an obligation to change this promise to shares. When they change the promise to shares, when they take up equity shares of the company, then the one-offs will increase. And when the one-offs increases, automatically that will reduce what here, the EPS, the earnings per share. Earnings per share. So, ladies and gentlemen, here we are learning something very important here. Yes, great. So, ladies and gentlemen, we are told here